Welcome back to the Money Puzzle and another episode of the Retirement Planning Happy Hour. Eric Douglas, Chris Vaughn here with Family Wealth Planning Partners. Thanks for joining us. So we are going to spend a little bit of time talking about recency bias. Right. It's something that's become a pretty recurring topic in most of our client meetings here recently. Really because of what's happening in the news cycle and all of the negative headlines that you see and you hear about. And I want to juxtapose that to actually what is actually happening within the market itself, and how what's actually happening versus what people think is happening can sometimes be two completely different things. But really, when we talk about recency bias, just the idea that what is currently happening is going to happen in perpetuity forever. And we have a number of examples where we're going to highlight that is not always the case. But in order to help us discuss this topic, you want to talk about what we've got here with us?
Okay, so today we have a product from Michter's Distillery right here in Louisville. This is the let's make sure that I'm saying the right thing. This is one I just pulled off my shelf. I've had it for a little while. It's the Barrel Strength Limited Edition Michter's. Now, if you know anything about Michter's, they do their proofing a little bit differently than most companies. Most companies, when they distill, the juice goes into the barrel at about 125 proof, and then based upon how it ages and everything, they then cut it down to the proof they want. Michter's puts it in at a much lower proof, which is kind of an old-fashioned way of doing things. The concept is that you get a lot better flavor, you get more complexity, things like that. However, you sacrifice yield because they're going in at a lower proof. They can't cut it with water as much before they put it in a bottle. So this is their barrel strength, and it's 120.6, I believe that says. No, I'm sorry, 110.6. So this is very, very low for a barrel strength whiskey. But I can tell you that you're probably going to get a whole lot of flavor out of that one as we're going through this. I did remember to bring our little thief so that we can put a couple drops of water in it if you want to kind of mess with it a little bit. But that's what we're drinking today while we talk about recency bias and probably go down a few rabbit holes while we're on it.
A lot of flavors with that one, so we'll definitely revisit that one quite a bit. So, but this was stemmed from a conversation that you had with a client yesterday evening.
Yep.
And this mirrors almost an exact conversation that I've had with a lot of clients recently. Yeah. Not that it's good or bad. But clients come in and they have concerns, and we discuss those concerns, and we want to be upfront. And I'm kind of leading off a lot of our meetings right now, just, hey, what are you hearing? What are you thinking? I want to make sure that we're laying any concerns that you've got out on the table so we know what to address first and foremost. And so talk about the conversations that you had last night, and we'll go from there.
Well, first of all, I think it's important for context that the people who are watching or listening to this know when we're recording it.
Yeah.
Because things are changing in the news cycle on a minute-by-minute basis. Today is the Friday of Memorial Day weekend. So before I go any further, a little gripe. I'm ready for some warm weather. I don't know about you. I got up this morning, 6 o'clock in the morning. I put on a T-shirt and shorts, no shoes. I walk out on the front porch to let the dogs out. It was 45 degrees in my house.
It looks like it should be a lot hotter than it is. It's a gorgeous. I'm looking out the window. It's a gorgeous day right now.
And they got our air conditioning in our office fixed this week, so it's really blowing. I came in with a sweater on this morning. So anyway, that's kind of our context on time. So last night I'm talking with a client of ours, and she's very, very concerned about what's going on politically. And she said, the markets are horrible and I'm losing money, right? Which I said, okay, so over what time frame? And of course I got the absolute deer in the headlights look. And I said, well, let's look at your portfolio, right? Over the last year, she's up almost 8%. Right?
In a conservative.
In a
very
because this is a
portfolio.
pre-retiree. She doesn't have a tremendous amount of money, but she's okay, but almost 8%. And now the question that I say is, if I told you I'm going to get you 8% next year, you would probably go, sounds good, sign me up.
A lot of our clients certainly would, yeah.
But I think that's where it comes in. She's doing what same thing most other people do. They watch the news, and we've talked before, if it bleeds, it leads.
Yeah.
News people don't report on good things because then you don't watch, or you don't read, or you don't consume that content, whatever it is. So that's where we got into the recency bias conversation. She's looking at what the markets are doing right now. And I think you had another client earlier this week, same exact problem, right?
Oh, it's not one client; it's a lot of clients.
Well, yeah,
and most of them aren't necessarily. At least the ones that have been longtime clients have seen these before, and they understand the volatility, the natural volatility that you're going to have, and they've seen us work through some of these storms before. So they're not necessarily concerned per se, but they might have questions, or they're asking what our opinions might be of what's currently happening within the market. But you do have some other clients that are maybe newer, haven't been through some of these storms, quote unquote, right? I don't know a better term to use, but some of these, economic or political storms with us before, because we have, brought on a lot of new clients over the last 2 years, and we haven't really experienced much volatility since the end of 2022. So it's definitely a topic of conversation with a lot of clients right now, for sure. But to your point, she thinks, the headlines that were in effect from a couple months ago and all the bad news that she's still hearing politically is still translating to the markets as a whole.
Well, and I'll add to that. I've said this since I got into this business. I'm sure I will be saying this past my retirement date. What you have in your personal portfolio and the markets, what you're seeing on TV, which are the major indices, maybe a handful of individual stocks or bonds, it's not the same thing. They have some amount of correlation to them, but when you turn on the TV and they say, oh, the S&P is up or the markets are down or whatever, that's not what your portfolio is. You might have some of that.
Sure.
But so everybody who's listening, please, what you have and the markets are not identical. So please don't make that assumption in your head. It'll stress you out for no reason.
What always strikes me when it comes to recency bias in particular, so many people think that the idea of recency bias is the idea that what's currently happening is going to happen in perpetuity.
It's going to continue to happen.
What's happened most recently is always going to be the thing.
Right.
And whatever happened in the past is completely in the past, and it's never going to happen again. So we have this tendency to focus so specifically on what's happened most recently, as opposed to zooming out and looking at things through more of a historical lens, right? And so what's happened recently this year? Let's just even say more specifically over the last 3 months. All of the talk about tariffs, all of the talk about the trade deals and what's going on, and that caused a ton of volatility in the markets, and we've talked about that before already, right? So we have a lot of volatility, and people think, because you hear all of the bad news, and whenever the stock market is crashing or correcting, in this case, it wasn't even really a crash. We had a correction. We had maybe a little bit more than a correction, but what's happened since then with the major indices anyway?
The major indices are up since then.
They've rebounded, and they're not. Right. At one point, they were back over. They were in positive territory for the year. Right. We haven't recovered completely back to where we were at the top because the markets had gone up since the first couple months of the year. So we haven't completely recovered from the crash, but we're back in positive territory for the most part in most of the major indices year to date.
So if you remember, I'll take the S&P 500. So just as a reminder, the 500 biggest domestically based companies. When we use the phrase "the market," typically that's the best indicator of the market, not the Dow. That's only 30 companies. So if you look at the last 3 months on the S&P, so that takes us back into the end of February, when the tariff discussions really started, right? And then obviously beginning of April when we had the I can't remember what Trump called it, the Independence Day.
Liberation Day,
yeah. Not the phrase I would have used for it, but it is what it is. You took that nosedive. We went off a cliff there for a little bit. So over the last 3 months, the S&P is down 2.97% as of right now, right? Now remember, historically, it averages about 10% positive per year, okay? But if you look at the last
that's the average. It's important to remember that's the average, and very rarely do we ever actually get the average.
Correct. It's almost impossible to get that number,
most years, you get a lot more or a lot less. That's how you end up at the average.
So let me add to that. So that's an excellent point. So we're down in the last 3 months, 2.97. But in the last month, we are up 7.51. right? In 1 month, we're up 7.51%. So does that trend continue? I don't know. I wish I had that crystal ball. Yeah. You know, I've had people go, well, what's going to happen? I wish I knew. You don't know? No. If I had a crystal ball that told me what's going to happen, we wouldn't be sitting here. I'd be on my own island in the Caribbean somewhere, right?
Yeah.
And that kind of goes back to the recency bias, right? It was in the news this morning, right? We've got another big tariff thing that Trump came out and made a comment. I didn't read that much about it. I think you did a little bit about possibly putting on a 50% tariff on the EU. And then there was some specific talk about Apple.
25% tariff on Apple because they're making their phones in China.
China, right?
Yeah, and if the tariff goes away if you make them in the United States, and there's we were talking and chatting briefly before we started recording this, but logistically that's just not going to happen. Apple is not going to reshore those jobs. It's not going to happen for a number of different reasons. But at the end of the day, he's threatening a new tariff on an individual company. We don't need to go into the
legality of that later, right?
That's a whole other issue there, and we're not going to go down that rabbit hole necessarily. But the point is, because things had kind of been quiet for a little bit, and you saw the market rebound, right? Because we weren't getting random tweets at 8:30 a.m. right before the market opened, right? And so a lot of the volatility had honestly gone away in the market, and things were boring, which I love boring in the market because that usually means things are pretty good. But it's interesting because, you had such volatility, and we had the correction and maybe a little bit more than a correction, and that got all of the press in the world. You're still getting all of the negative headlines. However, the market in the background has rebounded, to your point, with the numbers that you just showed.
You just said it a minute ago. You like boring. We like it when the VIX indicator is low, right? Yeah. That means boring. But that's not good news. That's not what's going to make you watch or read or listen to whatever the news is that they're trying to report. So I want to go back into the recency bias a little bit. How many clients? We've got some large companies here in the Louisville area that their employees tend to be very, very loyal, and they tend to be loyal to their stock as well. So you and I were talking before we got started. I've got a client that we're onboarding right now that they're retired, but she's got some stock that she got from her company, in her company when she was still working. She's been retired 8 or 9 years now. But she made the comment to me yesterday. She said, I'm not sure if I want to sell that because that stock has done really, really well.
Yeah.
So that goes back to the recency bias thing. And I got to thinking, and I said, I probably should let her know about business risk. So business risk is the concept of an individual business going up or down based on factors that only impact that business, as opposed to market risk, where the entire market or a sector of the market are exposed. Mm-hmm. So the Apple thing, Apple is now under a serious business risk situation. And we've got a lot of stories. I think we should probably share a couple of them. But one that I think about that's a business risk, this is the reason why we don't believe in individual stocks in a retirement portfolio. It's fine if you want to do them in a playground account or whatever you want to call it. Is because of business risk. And the example that I always like to use is several years ago when we were having the whole Me Too movement thing. Now, you can argue whether the Me Too movement was a good thing or a bad thing. I'm not going to do that. What I'm going to say is there was a company out there at the time, and they're still around, called Wynn Entertainment, W-Y-N-N. Now, that's the company that has the Wynn Resorts and casino and everything out in Vegas.
Wynn, Encore.
Yeah, they've got some other things too.
Bellagio at first, yeah.
Exactly. So Steve Wynn, who started that company and was the CEO of it, he was a known Republican contributor, right? He contributed to Republican candidates. Well, you can like that or you can dislike that, but it does put a little bit of a bullseye on you sometimes. So a woman came out and accused him of sexual assault. Nothing ever came of it. Not one friend, family member, nobody would corroborate her story. And she had no evidence of any kind. It was a true accusation. The police and the district attorney said, we are not going to prosecute because there is no evidence here. But the stock value was cut in half while that was going on. To save the company, he had to resign as CEO. Mm-hmm. So that's a great example of business risk. The company did nothing wrong. It was still a good company. But for whatever the motivation, I'll let you read into that, an accusation was made about a high up in the company, and all of the people who owned that company lost half the value of their investment in a matter of a couple of weeks.
Well, even to bring it home a little bit, so that's a great example, but to bring it home a little bit, let's just use a couple companies that are headquartered, or not headquartered, well, one of them is headquartered here in Louisville, but Humana and UPS, two of the biggest employers in the city of Louisville and really the state of Kentucky, right? Pull up UPS's stock price.
All right, UPS, as of right this minute, is $95.45.
And what was it a year ago?
A year ago, it was $139.10.
So that's a drop of
31.36%.
Yeah. So a drop of over 30% over the past year. Over the exact same time frame, the S&P 500 is up about 10.
See, I'll get you the number. Over the exact same time frame, it is up 10.13%.
10.13%. So
it's average. I mean, we were just talking about you're never going to hit it. We're pretty much right at the average over the last year.
So we've got a number of UPS clients, and we'll get to Humana in a second as well. But I heard a lot from Humana clients. I'm sorry, from UPS clients a couple of years ago when the stock price was roaring during COVID, right? Because everyone, deliveries were through the roof. Everyone was staying at home. And people were ordering online. So UPS's stock price, along with FedEx and other, members,
Amazon, all of the
others
ones
in that
delivery,
others in that same category. But all those stocks were just flying high. And I remember talking to a number of UPS folks that did not want to sell their stock because, the stock is killing it right now. The stock is doing so well. Why would I ever get rid of this stock? Why would I diversify? Because the stock has done so well. Recency bias, right? Because the stock had been doing so well recently, they thought that it was always going to do well in perpetuity. And as you can see, just over the past year, whether it wasn't even really the tariffs, but it was just, not as many people were doing stuff online. The economy started to slow down a little bit. Orders were down. There were some other new competitors. I think there was some, whatever the reasons were, right? There was a number of different reasons, but all these things came together. All these factors contributed to the fact that UPS's stock has plummeted over the past year, especially relative to the rest of the market. And so when you get so tied into, one, emotional investing, but two, thinking that what's been happening recently is going to always happen, that's where you can really get into some serious trouble when it comes to the success of your portfolio, and as it relates to what we do really in our day-to-day business, right? The success of your retirement plan overall.
Yeah. So, and just to solidify what you were talking about, in this particular case, UPS had a huge run-up, as did a lot of other companies, because of COVID and the things that went around it. And I'm just looking at the chart, and we talk about how charts tend to look like mountains. They got little jaggedy points in them, but they eventually are going up. UPS has an absolute cliff going up during the COVID lockdown period, right? And you understand why. And then it continued to go up into 2021. But over the last 10 years, the stock is down 3.8%, right?
So flat over the last decade.
Exactly. Over a decade, it's basically a flat stock, right? Yeah. It's a great company. It's a great employer. You don't hear a lot of bad things about them from their employees.
Employees love it. But when you're looking purely from an investment standpoint at the specific stock, I didn't realize it had gone back down that low over the past decade. It'll come back.
Yeah.
On a long enough timeline, they always come back. Not always, but for the most part, a company like that will come back.
Right. This is the kind of company that's going to stick and move and adapt as the marketplace changes. I'm not real worried about them, but from an investment point of view, my stock has done well, you said. Yeah, but what does that mean about tomorrow, right?
So... But that's recency bias at play. Now let's look at Humana.
All right, Humana.
So Humana, same data.
Another major player here locally.
What's the stock price right now?
Okay, the stock price right now is $223.34.
And a year ago?
A year ago, it was $352.22. So over the last year, it is down 36.59%. And there is a big drop off if you look at the chart what it looks like end of September, beginning of October last year, it took a big hit. So obviously there was a news issue there, but there is a downward trend line if you look at it overall.
And if I remember correctly, there was something with legislation and, because they're tied up, they're so tied into Medicare and Medicaid reimbursements that there was some issue there, if I remember correctly. And they also had a number of layoffs, and there were some other things going on too. But all that to say, that stock prior to that point had done just enormously well.
Right.
It had done tremendously well prior to that. And it was the exact same story that we had with the UPS folks. You talk to enough Humana employees and like, oh, well, we're Humana. Like,
right.
We're huge. We're always going to do well. We're killing it. Until they're not.
Right.
And that just opens up a world of risk when you take into account what's happened most recently and think that is always going to be the case.
Well, and you could take that a step further. There are companies that anybody who's over the age of 25 knows the names.
Yeah.
That these were companies that were once, they ran their part of the world. They were part of our lexicon, if you will. That those companies either don't exist or they are virtually unheard of anymore. First one that pops into my mind is Xerox. Mm-hmm. There was a point in time not that many years ago when you didn't say you were going to copy something. You actually said you were going to Xerox something. That was part of the lexicon in this country, right? When's the last time you saw a Xerox machine?
Yeah.
Right? Even if you do see a copy machine, because there's not that many. I was stunned last week. We've got another company that we're friends with the owner. They lost their building in the tornado a few weeks back. And until they get a new building, they are actually taking up some of our space in the back of our office. And I saw this big copy machine wheeled in. And I was flabbergasted. I hadn't seen a copy machine like that in years. But you know what? It wasn't a Xerox.
Yeah.
You can think about other companies. Kodak. Kodak didn't adjust to the market when they had the opportunity. That company's gone, right?
Yeah.
A little bit more local. Remember Lexmark?
Oh, Lexington? Yeah.
Lexmark was the printer. You didn't want anything else because they were good, they were inexpensive, and they freaking worked.
Well, even getting away from that,
they're just gone now.
Kind of even getting away from printers and washed up
technology, right?
But GE's another
great example.
Was another behemoth and with local ties, obviously, and once again a great company. It's still around. It's still a very large company, but it's not what it was, especially kind of in the greater culture, right?
Mm-hmm.
This is not the same company that it was 20, 30, 40 years ago, and so. This is also kind of leading me into maybe thinking about what has been the driver or what has been the driver for the success of the S&P 500 over the last, let's say, 3-4 years.
The Mag 7.
Really, since COVID.
The Mag 7. Seven companies.
So the Magnificent Seven, and we talk about this a lot, and they're the ones that you would think about, right? Your Facebook, Amazon, Apple, Google, Tesla, NVIDIA, Microsoft. 7, right? I think I got them all. First try. Yep. Those companies have been the standard bearer. They have been the ones that have basically carried the S&P 500 and the market as a whole over really the last 4 years. Wonderful companies. I'm not saying anything bad about any of the companies individually, but they've had outsized returns relative to the rest of the individual stocks for the most part in the broader market. We started this conversation talking about Apple and why you have to understand recency. You have to take into account recency bias and specific business risk when you're evaluating individual holdings within your portfolio. Because we started off this conversation talking about a random tweet that happened about 8 o'clock this morning, talking about how they were going to put another 25% tariff on Apple specifically for making their phone. Any phones that are made or manufactured in China are going to have a 25% tariff on them coming into the United States. We can't plan for that, right? Like I was at the gym working out, and I just happened to check, stock futures before I came into the office today, and I'm there's nothing I can do. There's nothing I could have prepared for. The market isn't even open yet. Came completely out of left field. So, not that we're holding individual Apple stock in any of our models, but if we were, I wouldn't have had time to react or prepare for that.
Correct.
At some point, these mighty giants, not that these companies are going to go out of business, but other giants will rise, right? And these current giants will fall at some point. There's a lot of speculation. I'm not saying this is going to happen, but there's a lot of worry over at Google because how did Google build their business?
They built their business on a search engine and advertising.
Search engine, exactly. What are people fearing, or what do people think is going to start replacing the search engine? And it's already starting to, but especially over the next, let's say, decade.
AI.
Exactly. ChatGPT, Grok, all these other different AI companies where you don't need to type anything. You just pull up your phone and ask it, right? Everyone's got Siri on their Apple iPhone.
Right.
Amazon has something for Alexa.
I wonder if they're going to try to put a 25% tariff on Siri.
But Microsoft has Copilot. They're all coming out with their own versions of AI. And there's a lot of worry within Google, which has been an absolute behemoth of a company over the last couple of decades. It's grown tremendously, and it's been a great company. But through no fault of their own, new technology has emerged, and there is a real threat to the success of that business over, let's say, the next 10 to 15 years. I'm not saying nobody thinks Google is going to go out of business, and they have an entire suite of other products with, Gmail and, like you said, advertising, and there's other aspects or other business lines that they have, but search built that business.
Yes, it did.
And if anything happens to search, they're in trouble. So you have to keep those things in mind, thinking, what's gotten us here isn't always going to get us to the next place. Mm-hmm. And if Apple has to start paying additional tariffs on all of their products that are made in China, that's going to increase their costs significantly. Yep. And if you start increasing costs on the American consumer, and we're kind of to the point with the inflation that we've had over the last couple of years, you could argue that American consumers are kind of tapped out when it comes to inflation. And there's really not much more inflation that you can build into product lines. So Apple could be in some serious trouble. I'm not saying they are, and quite frankly, this is probably nothing more than a negotiation tactic, and we've seen that before, right?
Yep. I think we did a podcast on
exactly.
that. Exactly.
But if this thing has legs, Apple could be in some real trouble. Mm-hmm. Once again, I don't think that they are right now, but they could be. And you never know what's going to happen, with any specific business risk or any specific legislation that might pop up in the future.
Right.
So
it's just one of those things that kind of comes back to when we talk about recency bias and people are like, oh my goodness, the sky is falling. We've been down this road before. Mm-hmm. We had different causation the last time. I can't think of anything off the top of my head where you had a major downturn in the markets because of something that we've had the exact same thing happen before. It's always something different. But once again, it goes back to what have the markets done if you give them a long enough period of time, right? Mm-hmm. And people talking about the latest thing, you said it a minute ago, whatever it is now, that's the way it's going to be in perpetuity. Well, think about politics, because we do that with our politics all the time. 3 months ago, I remember people saying on the news, there's no chance that the Republicans could ever lose again. That's the stupidest comment I think I've ever heard, right?
Well, right after you heard all the Democrats not too long ago talking about, Republicans will never be in office again. Right. So that always goes back and forth, and I'll laugh every time that I hear it.
Yeah.
But that's never the case. There's always a pendulum, and it swings back and forth, whether you're talking about economics, whether you're talking about politics, really any aspect in life. Very rarely is everything so extreme that it never comes back.
I love the analogy that you just said. It's a pendulum that goes back and forth, right? But if you think about a pendulum, when it gets all the way to its peak before it turns around and goes back the other direction, it builds a lot of momentum as it's going back. That's true when it comes to the markets. That's true when it comes to a lot of companies as we're going into the stocks of those. That's true about in politics. Anything that it is today, is going to change, right? So what you have to do is you have to look at historically what is most likely to happen over a window of time. And that's a much better way to structure your investments.
What do you say, because I know what I say, what do you say when clients say or suggest or maybe ask, is this like the new .com? Is this like the new real estate crash? Is this like 08 happening all over again? What do you say when, especially, when the market was having that correction and people were really, really scared? How would you answer that?
The way that I answer it is 08 will never happen again. The .com will never happen again. It'll be something different next time. It's a different catalyst. It's a different cause. We've been down this road before, but here's the advice that I give people. So the most recent one that we were really scared about was the bubble from the Magnificent Seven that we've been sitting here talking about. Those 7 companies were so inflated theoretically that if they started going down, that the whole market would go with them. So
because they made up about over 40%
over
of the
40% of the S&P in 7 companies, right? Which is terrifying if you think about it. What I tell people is, why would you be invested in those 7 companies exclusively? It's okay if you own them. There's nothing wrong with that.
No.
But that's the whole point of being diversified, so that when the market takes a downturn, you don't go down as quickly. And when the market starts to go back up, you have the ability to take advantage of that. But the big one with our clients is the money that you have that you're going to be using in the next 15 years is completely unaffected by that, right? This is not a concern at all. We know the markets are going to go up and down. It's a natural part of it. The up and down part of your portfolio, we're not going to touch that for over a decade. So there's nothing really to be concerned about. That's what I tell people.
I've been laughing a lot when I'm listening to the news and I'm hearing prognosticators and pundits and people smarter than us, right? All these people that are, so smart they get to be on TV. But comparing what we're going through now to the dot-com crash or to the real estate foreclosure crisis that we had in 08, 09, this is absolutely nothing like that, either one of those instances. Right. There was a specific catalyst. There was a specific trigger that happened with the dot-com crash. We had valuations on specifically tech companies that were just completely out of whack. We had these companies that were drawing so much money in private equity, the valuations were just through the roof. And they turned out not to be worth anything because at that time, the internet, it's hard to believe this really isn't even that long ago, right? It's not. But the internet was still very, very new in the early 2000s, in the late 90s and early 2000s. And everybody knew that it was going to be the next big thing, but nobody had figured out a way to kind of monetize it yet. And so you had all this money flowing into these, dot-com companies, but they weren't making any money. Let's call them pre-revenue, right? Just on the idea that they might
pre-revenue.
That they might make money in the future, and that's quite frankly what private equity is. It's a big gamble. Well, a lot of those went belly up before they could start making real money. So that was kind of the catalyst that led to the overall downturn in the early 2000s. 2008, completely different story.
Unrelated.
Exactly, and we had a major foreclosure crisis because companies and banks were lending money to people that, quite frankly, couldn't afford to pay it back. And it was an arms race because, rates were starting to lower, and it was becoming an arms race to see who could lend out the most amount of money because, debt was cheap, and everyone's always going to pay back their mortgage, right? No one's ever going to default on their loans.
That's the way that works.
Yeah, and we did an episode about real estate recently, but quite frankly, we're not going to have another 08 because when you look at the number of homes that are owned in the United States, free and clear, it's just astronomically higher than it was in 2008 and 2009. I think the last stat that I heard, it was something like 43% of all homes are free and clear, have no mortgage. Not to mention all of the homes that are owned by investors and Airbnbs and rental properties and things like that are owned by corporations. We're not going to have another real estate crash like we had in 2008 and 2009. Not to say that the real estate market is bulletproof by any means.
You can have another real estate problem, but it won't be the same thing.
It's not going to exactly. It's not going to be the same thing. So whenever people try to compare what happened this year with the tariffs, I've always laughed because listen, the only thing that happened with the tariffs was there were some tweets and some threats. Nothing broke. We had things in the economy that broke in the early 2000s and 08, 09. Yeah. Some very serious things that broke. Nothing is broken yet. Knock on wood, right?
Yeah.
Yet. Nothing has broken. There was a lot of fear. There was a lot of anxiety, probably more anxiety than fear, really. But people just didn't know. Most people didn't even really know or understand tariffs.
I would say 6 months ago, most people didn't know what the word tariff was.
Exactly.
It was not something that people talked about.
And so you just had a lot of fear and anxiety built up because people thought the market was already overvalued, to your point, because of the Mag 7 that had, driven valuations up so high in the S&P 500. We were due for a correction, and we needed a catalyst to generate or to cause the correction. Trump came out and said some things, and the messaging wasn't too terribly great, for lack of a better term. Actually, there probably is a better term, but I'll leave it at that. But the messaging wasn't very great, But the messaging wasn't great, and things took a pretty quick, downturn. They've rebounded, and of course, no one's talking about the rebound, and it's hilarious when I'm pulling up accounts for clients right now, over the last couple of weeks, and I'm showing their clients is either flat or even positive year to date. And like, oh, wow, I had no clue.
I thought everything was down.
I thought the world was ending.
Yeah. Chicken Little, right?
Yeah.
I pulled that up. Going back to this whole recency bias thing. The markets are down. The sky is falling, blah, blah, blah. Okay. Now let's look at the S&P 500. It's our measurement of the markets again. And we said, year to date, we're still down. Took my glasses off. Sorry about that. We're down 0.83%. Oh, my goodness, the sky is falling. Over the last year, we said that the average is about 10%. As of right now, it's gone up just a little bit since we said this a while ago, 10.48%. But over the last 2 years, you want to take a shot at that one?
Oh, it's over 25.
40.38, right? Just in the last 2 years, okay? And you can say, okay, well, but 2 years ago, roughly 2 years ago, we had 2022. So we had a downturn, so that looks wrong. All right, let's look at the 5-year. 91.15, right? Oh, but 5 years ago was COVID and we had the big hit. Okay, let's go at the 10-year. 176.14%. So I think the moral of that story is, and you asked me the question, what do you tell people? If you are in a good portfolio, then it should be designed for the time frame when you're going to use it, stay the course.
100%.
Just stand pat. And I've heard you say this in workshops and stuff with clients all the time. When it comes to accumulating wealth, save it, leave it alone. That's it. That's all you got to do. Just leave it alone. It will do what it's supposed to do as long as it's invested correctly. If you're investing in an individual company, be aware that things can go sideways on you, even when everything else is good, right? That's why you have a diversified portfolio instead of betting on individual stocks.
Yep. And we're going to start talking about this bourbon here in a second. But
I think that's a great idea.
I want to close this up because when it comes to recency bias, so much of where people get their information from is from political news sources.
Yeah.
And so they equate political news with economic news. And they're so not the same. You would have thought that the correction we had earlier this year was singularly due to Trump's tariff talk. It was not. Quite frankly, most of that correction had absolutely nothing to do with Trump's tariffs. Right. But that got all of the headlines because it was being used as, a hammer against Trump to kind of hammer him and his policies. You cannot get your economic news or your financial news from political news sources because every single political news source, both right and left, is going to be coming from a very specific slant.
That's right. And
they're going to have an agenda that they're trying to push. This goes back to 2022 when, the market was horrible in 2022.
Right.
Horrible. The bond market broke. The stock market was bad. It was just a really, really rough year in 2022. Yet you really didn't hear much about it. And in the places that you did hear about it, a lot of, especially if you were on the left, you were defending Biden and his policies and, this is, what happened because of what Trump was doing. And, this is just the chickens coming home to roost. And then, now you're blasting Trump because, we had a stock market correction and it was down a little bit and we had some volatility. So you completely changed your tune when the market was crashing.
Because it served your purpose.
On the flip side, I'm listening to Republicans, and they're saying, the market's crashing, but we need these tariffs because we need to punish these other countries because of their trade policies against us, and we're losing the trade war, and this is really healthy long-term for the market. Going back to what they were saying in 2022 when the market was an absolute wreck and they were blasting Biden, they were blasting the economy and how horrible everything was because the stock market was collapsing. I cannot stress this enough. Do not get your economic news from a political news source. They don't know what they're talking about when it comes to this stuff. Because I consume political news too. We all do, right? And I consume political news. And whenever they start talking, whenever I hear anyone on the political spectrum start talking about the stock market, I immediately start cringing for what I'm about to hear. Every single time, because they do not know what they're talking about. And yes, I'm talking about your favorite commentators. I don't know who you are, but I am talking about your favorite commentators, whether you're left or right, because they don't know this world. They don't live in this world. They live in the political world.
Well, let's be real honest. They are journalists. That's their job, is to be journalists. They don't live in this world. Even though they might be reporting on it, they are journalists by trade, which means they have a different slant on everything.
Well, journalists, talk show hosts, podcasters, just anybody kind of in that political world, right? Whatever you want to call them, because I think a lot of people probably wouldn't want to call themselves journalists. But
I got a great joke I told you the other day we could do.
But anyway, that I think that's probably a pretty good place to wrap up our conversation. But we do need to talk about
let's talk about bourbon.
This delicious pour here.
So what do you think of this one? I've had this one before because this was mine.
I'd had it. It's been a long time.
Okay.
So when you look at the legs that it's got,
oh my gosh,
man, you can just tell it's thick. There's a lot of flavor.
Yep.
It coats. There's a little bit of a coat there. It's almost like I guess cough syrup, for lack of a better term. It kind of coats your throat a little bit.
Doesn't taste like cough syrup.
Doesn't taste like no.
Yes, I agree with that.
But yeah, it's kind of a thick taste. It's delicious. A little smoky.
Okay,
some
so
honey.
I was going to suggest. First of all, to me, it tastes a little bit like spicy honey.
Yeah.
Right. And there was also like a tobacco leaf flavor to it. So I'm not talking about like a cigarette burn, because as a former smoker, that taste is so repulsive to me. I can't be around it. I'm thinking more of, like fresh tobacco here in Kentucky. Where we live, there's tobacco fields around us from time to time. That smell, that taste that goes along with it, which is, I think, very desirable in bourbons. When I put a few drops of water in it, I lost the tobacco and I lost some of the spice on that honey, but I picked up something else. I want to see what you get when you try that. Anything?
Maybe I didn't cut it enough. I don't notice much of a difference.
I just put, I think, 2 or 3 drops in mine, and the oak really came out. The oak was not real heavy at first, but when I cut it a little bit, the oak really came out. And maybe that's because the spiciness was cut down just a little bit. If you remember, we did Stag a few weeks ago. When we cut that, the spiciness went up.
It's funny because the taste went from kind of back to front.
Yes, it did.
So now it's on. It's much more on my tongue. Yeah, I mean, I could see what you're saying. Yeah. I probably don't taste it as much as you did, and
that's fine. Everybody, that's something else that I think people who are just getting into tasting bourbons, whiskeys, maybe tequilas, any other types of spirit, we have a tendency to say, "What do you think? What do you think?" Right? No, that's not what's important. What's important is what you personally think. What do you taste? What do you like about that?
Yeah.
I've got a friend of mine that has a palate that is disturbing. He will pick up 5 or 10 different flavors when I'm going, I got one of those, and there'll be 2 or 3 people sitting around us going, tastes like whiskey.
Tastes like bourbon to me, yeah.
They've got nothing, and he's just pulling all kinds of stuff out. You don't have to be that guy. You have to pick up flavors that you like. Now, there is a science behind why you would pick them up. I think maybe one of the tastes that we should do is Old Louisville. If you've never been to Old Louisville, I'm a huge fan of that company. Amin, the guy who runs it, knows more about chemistry and bourbon than you and I will know in 10 lifetimes. And we were doing a tasting with him, and he said, do you taste cotton candy? Well, as a matter of fact, I do. And he said, the reason you taste cotton candy is because the molecular structure is identical to cotton candy. And I'm with a group of about 10 guys, and we're looking around going, that's the coolest thing I've ever heard in my life. You're geeking out when you're talking about the chemical composition of cotton candy. But that's the whole point. You can taste what you want to taste as long as you enjoy it. That's what's important. Don't try to do what somebody else likes.
So, very delicious pour.
Good stuff.
Stout.
Good stuff.
Stout for sure, but it's delicious.
It does not taste like 110 proof. To me, it tastes like it's a higher proof than that.
Yeah, I'll give it that. But a lot of flavors.
And I mean that as a good thing.
Yeah.
I mean, there's lots and lots of flavors and complexities, and I don't believe there's an age statement on this. I know that one of the things that Michter's does is they do their 10-year release from time to time. which if you've ever had the Michter's 10-year rye, that one's a true unicorn for a reason, because those of us who know what it tastes like, if we see it, we snatch it up. They do have a release coming out, I believe, later this year. They are doing the barrel strength 10-year release. I think that's right. I may be saying that wrong. Go wait in line for that one, because that one will be worth it.
Any parting thoughts?
It's Memorial Day weekend. I heard that 43 million people are going to be traveling this weekend, and about 4 million of them will be in the air. Be patient with each other. And by all means,
don't fly Spirit
Airlines. Get out
Airlines.
of the left lane if you're not passing. That's my parting thoughts.
Stay away from Spirit Airlines while you're flying. So,
well, unless you want a show. I mean, because that one can be quite entertaining, as I understand.
So, all that to say, thanks for listening. Thanks for joining us here for another episode of Retirement Planning Happy Hour. Until next time.